The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. And with me today, as always, for our final episode of the year, is senior Chanticleer columnist at the AFR, Tony Boyd. Hi Tony, how are you?
Great, James. Yes, this has become a wonderful sort of joint collaborative exercise, hasn't it?
Oh, it's great fun. It's great fun. And we've got a great episode. This week we're going to dig into the latest messes at the Star Entertainment Group and ASX. We're going to look back at the two defining stories of the year, and we'll look forward to 2023 with our first guest on the show, Katie Hudson from Yarra Capital Management.
Yes, and she'll also talk about her stock picks heading into the new year, and I'm very excited about that.
Brilliant. But first, Tony, this has been a week dominated by two actions taken by the Australian Securities and Investment Commission, the corporate watchdog, which is chaired by Joe Longo. Now, the first was on Monday at Star Entertainment Group, where ASIC has taken civil action against former CEO Matt Beckier, former chairman John O'Neill, and a host of other directors and executives who for allegedly failing to manage risks around the casino group's high roller business. Now, Tony, it's not often we see directors in the firing line, is it? What's special about this Star action?
Well, since he took over as ASIC chairman, Joe Longo, who's a former lawyer himself and a banker, hasn't really had a sort of landmark legal action, but this is definitely it. He is basically putting a stake in the ground to remind directors and senior management, particularly general counsel, of their duties and the need to exercise due care and diligence in what they're doing, particularly making proper inquiries about what's going on in their own business, especially when it gets alerted to them by the Sydney Morning Herald, The Age and 60 Minutes.
That's exactly right. Now, this was all about the VIP business. They had these guys called junket operators who bought wealthy casino punters from Asia to the Stars casinos in Sydney, Brisbane and the Gold Coast. These junket operators were allegedly backed by criminal organisations. The risks in this business was manifest, and what ASIC is saying essentially is that the directors didn't pay enough attention to this, even though it was clearly the most risky part of the business. What happens from here, Tony?
Well, I think basically from here, directors are going to have to read through what Joe Longo said in the exclusive interview he gave me, because he said there's three big themes here and he wants all the directors of companies to be aware of them. But he's also making the point that under the Corporations Act, these duties and obligations also apply to officers of the company. And so anyone who are the gatekeepers of information or certainly legal issues like general counsel have to be aware of their obligations to inform the board of matters that are going to the core of the business. So it's quite like I suppose you'd say, a bit of an inflection point in how Australia's legal authorities are going to look at the governance of companies.
Yeah, absolutely, absolutely. Now, you had Joe Longo back on the phone later in the week. ASIC's turning up the heat on ASX. Now, we mentioned last week that the ASX has come under fire for its mishandling of the project to replace the clearings and settlement system that essentially keeps the Australian share market running. What's ASIC trying to do here, Tony? What are they hoping to get out of ASX?
Well, for the first time in history, they've used their delegated power from the minister to force the ASX to prepare a report about the resilience and stability and investment that's being made into the old CHESS system that's been around for about 26, 27 years. And they've also appointed EY to do an audit of that report. So I think after being totally blindsided by the company and its failure to manage the project, ASIC and the RBA, who are also regulating that entity in terms of its market infrastructure, they've had enough, and they're basically telling the board, we're going to follow everything you do and go through it with a fine-tooth comb.
Yeah, well, we talked about ASIC being alerted to the problems at Star by the Sydney Morning Herald. Your columns at the AFR of what's kept the heat on ASX, so well done. Tony, let's jump to our first of two big stories of the year that we think are going to be the stories that people remember. The first one we want to talk about is the battle for control of AGL Energy, which has taken more twists and turns than your average thriller novel. The story starts in 2021 when AGL Chief Executive Graham Hunt and Chairman Peter Botten come up with a plan to split the company in two. It's going to be a coal-fired power generation company, which is the sort of bad AGL, and an electricity retailer, which is the good AGL. Now, this attracts the attention of software billionaire and greenie Mike Cannon-Brookes, who teams up with Canadian investment group Brookfield in March to try and buy AGL, arguing that plan to split AGL in two is bad for profits and bad for the environment. Now, that bid did fail, but in May, Cannon-Brookes was knocking on the door again. He bought an 11.3% stake in AGL and tried to scuttle the demerger plan. He won that fight and Botten and Hunt resigned, and then Cannon-Brookes came back again. He nominated 4 directors to the AGL board despite only having 11.3%, and he managed to get all of them elected to the AGL board at November's AGM. Tony, this one has it all. There's M&A, corporate activism, and of course the urgency of the energy transition. But at the end of the day, do you think AGL's in a better position now than it was a year ago?
I think they are, James, because that demerger would have given the company, in terms of its transition ambitions, less flexibility and options and capital. And, I mean, we know that's the case, that it was a bad idea, because Brookfield went and bought Origin Energy. In the middle of paying $18 billion for it. And the reason they like Origin Energy is because it's an integrated generator and retailer, and that's what AGL is now, and that certainly makes the company better prepared for the capital needs that are going to be required for its transition to lower carbon. But I suppose one thing that really stands out about this particular transaction is that it's not necessarily about the money. I don't think Mike Cannon-Brookes is doing this to add to his already $16-17 billion in wealth. This is really about him trying to use his power and influence for what he would say is the good of Australia, which is a pretty unusual motivation.
Yeah.
What did you think about the way he went about this?
I think that's right. It's a sort of very different type of corporate activism. Typically in Australia, we've seen corporate activism about trying to improve a company's profits or extract value, often by changing board members. That's true. But usually it's a purely financial motive. You're right, Tony. This is very different. I'm sure Cannon-Brookes would like to make money out of this in the long term, and he thinks he can. But that's not his guiding principle here. That's not his guiding light. And we've seen Mike Cannon-Brookes and to a lesser extent Andrew Forrest, who's jumped on the registers of some publicly listed companies as well, not with the intent of making money necessarily, but with the intent of proving some sort of point, typically around sustainability. Do you think this sort of corporate activism will continue? There's only a limited number of people who can do it, I guess.
Well, that's right. I mean, there's plenty of billionaires in Australia, but I couldn't see Gina Rinehart trying to change the board of a company to make it more green. But then again, look, I mean, the thing about billionaires is that they've got lots of available cash. They're highly motivated in building their wealth. And maybe we'll see other activities which are purely profit motivated. But the activism that we've seen at all of the bank annual meetings this week by green groups, the conversations that are being held in America about BlackRock. There was actually a call you may have seen during the week for Larry Fink, its CEO, to resign because they're coming under pressure because they're not taking their green credentials are somehow tainted by allowing companies they invest in to have too much exposure to fossil fuels. So I think this Cannon-Brookes wave of interest in companies to change is probably going to become even more common around the world. Yeah,
I think you're right. You mentioned the Origin Energy deal. So Brookfield bid for AGL Energy. That didn't come off. They then went away and made this $18 billion bid for Origin Energy, which they're in due diligence. It's likely to get done in the next few weeks and be completed sometime this year. Brookfield wants to invest $30 billion over the next 7 years at Origin Energy in renewables. I think that the general number at AGL is that they need to invest about $20 billion. Where's all this cash coming from, Tony?
Well, Brookfield has its own transition fund, which it built up in the United States, which I think is valued at about $20 billion. They are confident they can get more money out of other financiers and co-investors, which really is the sort of strategy that's used by Macquarie Group in its green energy investments, that they bring together their own capital, they bring together borrowings and co-investors. So there's probably, I think there is going to be enough money. It's just a question of how quickly can Australia pass all of the necessary environmental approvals for greater transmission lines, more approvals for pumped hydro, all of these things that have to happen to get Australia through the transition over the next 8 to 10 years.
Yeah, it's all about execution now, and that is no mean feat. Tony, what's the big moment for AGL in 2023? Where does this saga go next?
Well, these independent directors who say that some of them haven't even met Mike Cannon-Brookes, they're going to determine the new CEO, and that person, I think, will be very critical to the future of the company. If they get a person who's, say, thinks like Andrew Forrest, this whole thing could move incredibly rapidly. They might start to move into hydrogen. I mean, this is a really critical decision. What do you think? I mean, the chairwoman, Patricia McKenzie, had a bit of a sort of lot of tension there with the Cannon-Brookes camp. Is she going to survive?
I think a lot depends. You're right. A lot depends on who they pick as CEO. If they pick a CEO with a lot of charisma who can come in and sort of be the public face of this, well, then I think the board can disappear from view a bit, and then that can become a bit calmer on that front. But they need to get the right person. They need a public face who can walk the walk and talk the talk and make things happen. And that's no easy search. So let's see who they come up with, and let's see who this board, which is made up of some disparate figures, let's see who they can agree on. That's the big question.
The other thing I'm looking for when the Origin bid gets wrapped up is, what did Origin say to Brookfield in that period between the first offer and the last offer? They were able to share some information there that I don't think was publicly available, and that's what allowed them to pay that incredible 53% premium. So when this is all over, done and dusted, it'll just be fascinating to know how a board of directors and management were able to share information that nobody else had to make this sort of thing happen.
Another nugget to seek out in 2023. Well, Tony, the second big story of the year has been what's happened on markets. And this has all been about surging interest rates around the world. The US Federal Reserve on Thursday night took its official interest rate up by another 0.5%. And that means US rates have jumped from 0.25% at the start of the year to now 4.5%. While the RBA, they've taken rates in Australia from 0.1% in March to 3.1%. And Tony, the markets have been on an incredible roller coaster as a result of this. The S&P 500, that's the main Wall Street index, it was down by as much as 25% in the middle of the year, but it ends the year around down 17%. And in Australia, the turnaround's been even more impressive. We were down 15% at the trough, and now we're going to end the year down about 6%. This is a remarkable turnaround, Tony. Have investors gone up and down the roller coaster, and does this make sense?
Yeah, look, it's this sort of level of volatility is often very confusing for investors. And earlier this week, I had lunch with Bern Riley, the CEO of the Australian Retirement Trust, which is one of Australia's biggest industry super funds. I was just talking to him about what sort of calls come through to your call centre. And he said, whenever the market falls, we get people ringing up saying, should I switch out of shares into cash? And I think Australians are pretty financially literate, but there's obviously some people who think that every time the market falls, they need to somehow switch out of these risky assets. But what we've seen is that over the long term, all of these big cyclical moves end up with the line that's called equity markets going from left to right and from the bottom of the left to the top of the right. So I think people should keep that in mind. Mind you, there's tremendous sort of I suppose, different views about where the markets are going. I mean, what do you think about how we ended up and where we're going to go?
Well, I think we've seen a roller coaster, obviously, in 2022, and I reckon there's another one coming. I think, and this seems to be the consensus view on Wall Street at the moment now, is that we could see a big dip in equity markets in the first half of 2023 as that recession around the world or a big slowdown starts to bite and that hits company earnings. But then in the second half of 2023, we should get a recovery as central banks sort of take the foot off the throat of economies by keeping rates on hold or even looking at cuts. And we start to see equities recover. So I guess the message seems to be, if you thought 2022 was extraordinary, 2023 could be even more exciting in terms of the roller coaster that's coming. But Tony, do you see recessions ahead? I know you've been pretty optimistic on the Chanticleer podcast. Is that optimism holding?
Look, I'm hoping for a shallow recession in America. And just to give you an idea of the difference in people's perspectives over there, at the moment, the consensus for the S&P 500 earnings is $230 a share. Reading some forward-looking stuff from Morgan Stanley, and they're saying that it'll probably turn out at US $195 per share. So what that means is that there's a 15% difference between where the market in general thinks earnings are going to go and where a particular very well-informed investment bank in America thinks, which I think Morgan Stanley has the largest investment advisory network in the United States, so it has the biggest influence among high net worth individuals. So look, whether or not it's a shallow recession or a deep recession, I think equities will prove to be a good investment over the long term.
Yeah.
If that's a bit of a cop out for you.
Well, yeah, it's a truism though. In your defence, just to quickly touch on one other big story of the year. As part of this, what does the crypto collapse say about the year on markets, Tony? This has been an extraordinary sort of moment in 2022. Does it say that that FOMO spirit of 2020 and 2021 is now washed out of the system, or maybe not quite?
Well, two things. The messages I got out of all that was that first one, crypto is actually a barometer of risk appetite, and when risk appetite's low, nobody wants to know it. The other thing is, this came from someone who was listening to our podcast, Dan Roberts, one of the founders of one of the Bitcoin miners I lost a lot of money on.
Yes.
He straight away called me up, wanted to have coffee. And I think the message I got from him is that people in the industry of trying to mine Bitcoin actually have to manage their businesses like everybody else. They've got to manage their cost base. So they're going through a whole process of trying to make that company more efficient. There's another Bitcoin miner that I invested in. You know what they're doing, James? They're actually getting their nuclear power that they contracted to make Bitcoin, and they're selling it. They're selling it to other people because they can get it cheaper than others can buy their energy. So now that's a whole new take on buying a Bitcoin miner.
Wow.
But it's horses for courses, I suppose. But yeah, crypto is definitely in a dark winter, which I don't expect to lift till 2024.
Okay. All right, last one for you, Tony. Howard Marks, our old mate, the legendary investor who we saw in Sydney a few months ago, he put out a memo this week basically arguing that interest rates will stay higher for longer. Is that your view as well? Are you in the Howard Marks camp here?
Yeah, look, I think so. The Fed said it's intending to raise rates more to get growth lower and the unemployment rate higher. So they've got more work to do on that, and then they'll just leave it there.
Yeah.
I think that's what's going to happen. Now, the question is, will they then suddenly start cutting rates really aggressively because they went too hard? Let's hope they get to the right point where it doesn't cause a really terrible global impact.
Yeah. I think Marx's sort of central view is that it's going to be difficult for them to bring rates down quickly, and the Fed seemed to agree with this on Wednesday night. They basically said where we expect rates to be at 5.1% at the end of 2023 and then not be cutting until 2024. So everyone hoping that the central banks are cutting next year to support equity prices might be a bit disappointed. Well, Tony, let's come back after the break with our first ever guest on the Chanticleer podcast, Katie Hudson from Yarra Capital Management, and we're going to ask her for a few stocks to watch in 2023. Well, welcome back. If you're after some more Chanticleer content, you can sign up for our Chanticleer newsletter, which has links to some of our best columns of the week and, of course, our fantastic podcasts. Head to join.afr.com/Chanticleer and sign up. It's available for all AFR subscribers. Well, we're very excited because we've got our very first guest on the Chanticleer podcast, and it's a special thrill to welcome Katie Hudson. Katie's an Executive Director and the Head of Australian Equities Research at Yarra Capital Management in Melbourne, and has more than 20 years of experience in investment markets. Katie, thank you so much for joining us as our first ever guest on the Chanticleer podcast.
Oh, I'm excited. First ever. Thanks very much, James and Tony. Great to be here.
And we want to talk to you about 2023, but first, perhaps you might give us a little bit of a view on what's happened on markets in 2022. It's been an extraordinary year when you sort of think of the scope of where we've come from and where we've been and where we end up. How have you seen this?
Yeah, it's been an incredibly volatile year, and it's hard to even contemplate that the ASX 200 is back to where it started the year. So we've completely round-tripped, and here we are back at the start again. Different for the small caps, which is the part of the market that I focus on. They're still well down, and we can talk about that as we go through because there's an interesting opportunity there. But the other thing that's important to call out is just how polarised the market performance has been. Energy's been really strong, industrials have been really weak, resources very strong in a number of areas, but so very polarised, and we think that's creating a lot of really interesting opportunities. And then, of course, you've had this obsession with inflation. And, I think the big guessing game now is, are we at the turning point? And we've got some strong views about that.
Well, maybe this is my opportunity, Katie, to ask you what you think the macroeconomic environment will be like in 2023, especially in regard to interest rates and the impact that'll have on Australia and the rest of the world.
Yeah, well, we think we're pretty much at a turning point. As we head into 2023, we think the RBA will be actually downgrading their inflation targets, which is quite a different view, I think, from where a lot of people are at the moment. We think they've gone too hard now. And, certainly from a bottom-up perspective, we do over 2,500 company meetings a year. So we're getting a lot of data points every day. And the data points we're getting from companies is that inflation has started to roll over. So freight's back to pre-COVID levels. A number of hard and soft commodity prices are down more than 30%. A lot of the supply chain disruption has started to ease. And for a number of reasons, we think inflation numbers will actually start to be downgraded into 2023. And of course, that has obvious implications for where we are in the interest rate cycle. So that means we probably think we're pretty close to the end of the cycle, particularly in Australia.
So we're at 3.1% now. Do you think the RBA comes back in February and thinks about another rate rise or two, or do you think they might get back in February and say, well, we've done enough?
We think there's a good chance they get back and say we've done enough.
Right.
There's a small possibility of one more small cut. But I think what they're telling us is they're going to sit and watch the data, which is very different to what the US is telling us. We're certainly encouraged by what we're hearing from the RBA, that they're saying they're going to watch and wait. And if they do that, we think they'll probably be, pretty much at the end.
And just on that point you raised about the US, I mean, they're very hawkish at the moment. We've sort of seen them take a step down this week, obviously, with the speed of rate rises. But are you sensing there's more tightening to be done there? Is it a different ballgame over in the US with their inflation settings?
Yes, it does seem to be. They seem to be going harder and you're really wanting to whack the economy. But if you actually look at the underlying data, it's starting to roll over as well. They're pretty close to recession. Their unemployment's about to start rising. A lot of the activity lead indicators are rolling over. So, they do seem to be wanting to go harder. And, I think what's hard to know, because of course markets this week with the rate rise didn't believe them. The markets actually said, exactly, they said, we're either not listening or we don't believe you. And so as a consequence, markets sort of started to rally. So, I think that what's hard to know with the US is whether they're just trying to give us a contractionary environment, stop the market rallying, or whether they actually do believe that they need to keep going harder. Either way, it's probably not good.
And Katie, it's been an incredible year in terms of certain stocks. If I looked at the ASX 200, as I did earlier on the Bloomberg machine, the top stock I think was up 300% and the worst one was down about 70 or 80%. So in the middle of all that, if you pick the right stock in even a market that goes nowhere, you can actually do really well. And that's why we're so glad to have you giving us some good stock tips that may end up in the Chook Super Fund.
There's a bit of extra pressure for you, Katie.
I always monitor the outcome of the Chook Super Fund to see if I've beaten it. So I think last year...
I'm sure you would have beaten it this year.
Last year the Chook Fund had a bit of a tough time, so I'm going to be interested to see how it's gone this year.
Have you got any Bitcoin miners in your portfolio, Katie?
No. But you're absolutely right, Tony. The outcomes of the market this year have been extremely broad. Energy's been up 55%, utilities, which is basically Origin's, been up 32%. But then, of course, at the other end of the spectrum, you've had IT, technology down 30%, property down 17%. So really broad. But in that, I think there's a lot of opportunity.
So just before you jump into a few stocks to watch in 2023, what do you think's priced into the market in terms of a slowdown? You're saying we're at a turning point. Does that mean the market's priced in the turning point, and stocks might be able to pick up ground from here, or have we not quite got across this idea that earnings still have to fall a bit as the pressure comes on the businesses that you're talking to? Well, what's priced in? What's your sense of where earnings in Australia go, for example?
Yeah, so if you look at typical cycles, the market typically starts rallying about 8 months before the economic data bottoms.
Okay.
If that's the case, we're there now.
Right.
And then you look at what's in the earnings expectations, and over the last 3 or 4 months, earnings expectations have come back quite materially. So the market's now looking, for the ASX 200 anyway, at about 3% growth. But within that, it's industrial growth a bit stronger, and resources have actually turned negative now, and that's a function of what's happened to commodity prices. So it's very stock specific, it's very sector specific, but I think a large part of the market has started to price in that weaker economic outlook and the expectations that things are going to be tougher in 2023.
So just on that sectoral differences, so this year, amazing energy, bad IT, for example. How are you thinking about what sectors will do well in 2023 and what might struggle?
Yeah, so definitely trawling through some of those stocks that have underperformed. I think that's a really good place to start. Energy, we think, will be tougher next year. It's got expectations of very high energy prices being sustained, and we think that's going to be hard to deliver on. But within a number of sectors, particularly the growth part of the market and some sort of cyclicals, there's been a huge sell-off. In the part of the market that I look after, which is small caps, industrials are down sort of 30 or 40%. So, and growth industrials. So there's been a big valuation reset. And within that, that's speaking to a pretty big opportunity. The key here, though, is 2023 going to see economic recovery? Probably not. We don't think we're heading into the bottom and then we have a V-shaped recovery. So I think what happens through 2023 is we find the bottom and then people start looking for with a bit more confidence, particularly at some of the growth parts of the market, because growth will be scarce.
All right. Well, Tony's got his pen poised for the super fund. Give us a couple of stocks that you're excited about in 2023 or watching closely.
Yeah, so the first part of the market that we're looking to, that we've been sort of adding to over the last few months, has been the growth part of the market. Particularly in small caps, there's been a big sell-off. So companies which we think have got some long-term structural growth, we think look really interesting. And that's, so what we're focused on is the parts of the market that have had a valuation reset, where your earnings are probably in pretty good shape.
Okay.
So companies like Nanosonics look really interesting. We're big investors in Pinnacle Investments. There's a number of growth companies in that part of the market. Net Wealth is another one that we've been adding to. We think they're long-term structural growth companies. The valuations had a reset, and that's the first place we would start.
Yeah, okay. Nanosonics, just tell us a little bit about what they do and why that's interesting.
So they're a global leader in the medical device. So they have a disinfection product that's in hospitals. They've got 50% of the US market and they're rolling out all across the world.
Okay.
And so they're the market leader. There's no other company in the world that does what they do. And so that's a pretty good starting point. And then you've got a process where regulators are saying disinfection is not done properly. these guys are the only ones who do it well. Hospitals, you need to up your game and bring this technology into your hospital. So they're having a great rollout opportunity in the US, but then they're rolling out in the UK, in Europe, in Japan, early stage in China. And so, that speaks to a really long runway of growth. It's actually a really interesting medical device because like Fisher & Paykel, even probably better than ResMed and Cochlear, it has a very high proportion of its income from consumables. So it's got a really high recurring income. Right. So once you've got that device in there, day in, day out, they earn revenue from the consumable. And that speaks to a really, attractive install base. So we think that global opportunity, together with the attractive economics of their business, speaks to a really big opportunity.
And a couple of stocks in the sort of broadly what you call financial services in Pinnacle and Net Wealth, that you think there's a bit of chance for a rebound there after a difficult year?
Yeah, so obviously with companies that have had some exposure to markets, so Pinnacle obviously has equity managers, they tend to sell off. But we think that companies like Pinnacle look like a really cheap source of beta. So they have structural growth, but they've got leverage to a rising market. So that feels like a really good place to be. Great balance sheet, great management, really diversified portfolio, unlike a lot of the other fund managers in the listed market, which often have one product, one reliance on one key person and one asset class. These guys have a really diversified asset class opportunity and a really strong distribution both domestically and offshore. Yeah.
Tony, we should ask you, what's the process of reviewing the Chook Super Fund portfolio at the end of the year? Is it do you sit down with a pen and paper and go through them and dish out some hard marking?
Look, I've just been sort of hold and sit and not doing much, but I certainly like the idea of net wealth, Katie. I was looking at some data that was published by APRA about the net flows of money into superannuation funds, and I think it's right up there in the top 10. So that's a pretty interesting when it's up against companies like Australian Super and these big industry super funds with default inflows. The fact that it's doing so well suggests that that's actually voluntary money going in there from people who obviously like whatever asset selections they're providing. Am I right in saying that?
Yeah, well, they essentially sit behind the advisor network. So they're the platform that advisors, so outside the super fund industry, they're the platform that the advisors use to manage people's money, and they're winning a ton of shares. So they're, that platform business, Net Wealth is one of them, Hub's another one, are getting the lion's share of the inflows, and that speaks to really strong structural growth over time.
Katie, just broadly, these are challenging markets clearly. 2022 has been challenging, 2023 is going to be challenging. But are these exciting times for a stock picker like yourself? I mean, it's not often you get this disparity in markets and these sort of wildly different opportunities. Does that make it exciting?
Yeah, super exciting. I mean, the way our investment process works is we're sort of 3 or 4 year time frame investors, and particularly in the small cap market, we're just seeing more and more focus on short-term momentum. Nearly 40% of the small cap market is now owned by index, quant and passive funds. So that means there's a lot of money chasing momentum, and it speaks to a really, really big inefficiency if you're prepared to look on that sort of 2, 3, 4 year horizon and really stay focused on that. So yeah, absolutely. When you've got volatility, when you've got disparate performance, and when you've got a lot of money chasing short-term momentum, if you stay focused on that time frame, you can find a lot of opportunities. And look, the next 12 months, no question, we're going to be in downgrade mode. But if you look over the horizon for the quality businesses, they'll come out of that process in good shape. And I think this is the opportunity.
It's amazing, Tony, isn't it? We've never had more information in the market, more data, more publicly available stuff that the average mum and dad can grab. And yet, as Katie says, there's these inefficiencies in the market that make it a great opportunity for sort of old school stock picking.
Yeah, and I think over time, small caps have actually done better than large caps when the markets are doing well. Am I right in saying that, Katie, that it's the place to be if we are going into a recovery?
Yeah, absolutely. So the starting point is important as well. So today we've got small caps trading at a 25-year discount relative to large caps. So the starting point is pretty compelling. And then, as you say, Tony, when risk comes back on, small caps are absolutely the place to be. The other point I think that's interesting today is Australia probably will be a safe haven in 2023 relative relative to the US and Europe. And small caps tend to have much more exposure to the Australian economy just by virtue of the composition of the index. And so that's probably another really interesting sort of overlay.
And is that around this idea that we've got a lot of what the world needs, whether that's natural resources, food and commodities, rare earths, iron ore, all that sort of stuff? Is that why you say we're a bit more sheltered?
Well, a starting point is over 80% of our exports are, really, really strong.
Yeah.
As you say, resources, commodities like grain. So our starting point is our export market is really strong. The other issue is our starting point around the unemployment, around where interest rates are, is also in a really good place. So, I think we've got an environment where we can absolutely weather the storm in a relative sense a lot better.
Yeah, fair enough. Well, thank you, Katie. It's been great to have you. Stay there for a moment. We're getting into our listeners love to hear recommendations for, and it's a long, hot summer, we hope, ahead. And so we're going to find out what Tony's going to be reading over this long, hot summer, and we're going to come back and ask you for a recommendation too. Tony, kick us off. What's on the Chukra reading list?
Yeah, every year my three sons say to me, Dad, what do you want for Christmas? And of course, when you're the person who's got everything, I always go for a book. And so I've actually asked my three sons to get me 3 different books. Now, one of them is, and these all come from the Financial Times Best Books of the Year. One of them is called Mao and Markets, The Communist Roots of Chinese Enterprise, which apparently is quite a good book about how the Chinese never really lost their love of Marxism, and that comes through in the way they manage their economy. The second one is The Economics of the Stock Market by a guy called Andrew Smithers. When I was London correspondent for the Australian newspaper, he was then already a figure in financial markets doing analysis that nobody else was, so that should be quite interesting. And then the last one was Influence Empire, the story of Tencent and China's tech ambition. The reason I sort of look forward to reading that is that basically the Chinese under the President Xi Jinping have cracked down on technology. They had tremendous technology leadership, and but this company seems to have avoided all the problems of others and is doing extremely well. So it's pretty dry bunch of books there, Katie. I mean, there's no sort of crime thrillers or anything, but I just thought might as well just, while the heat's there and you're down on the beach, have a look at some sort of business analysis.
Relax with a bit of Mao. It is, that's why he's the smartest Chanticleer columnist at the AFR. Katie, anything you're looking to listen to, read, watch over the summer?
Sure. Well, I'm just in the middle of reading Sapiens, A Brief History of Humankind. I just find history so interesting, and I always learn a lot as an investor by understanding how markets and industries and societies have evolved. So that's certainly been interesting. Well, that's one I'm partway through at the moment. From a podcast point of view, you absolutely can't go past the Yarra Exchange.
Of course.
And particularly when our amazing head of macro and strategy, Tim Toohey, is talking, I listen to it to get his insights, even though he sits about half a metre away from me, because he's just incredible. And so please listen.
Yarra Capital Management's Yarra Exchange podcast. Very nice plug there, Katie. We appreciate it. 2 from me. I've had Bob Iger's book, The Ride of a Lifetime, on my bedside table for a long time, thinking that he was going to be retired forever and I'd have a long time to read it. But now he's back, so I better dust that one off and read that one. And the other one was from the FT list as well, that is on order. It's called Chip War, The Fight for the World's Most Critical Technology. I think we're going to be hearing a lot more about chips and where they're made in the next few years. So hopefully that'll give me a bit of background. Katie, thank you so much for coming in. It's been terrific to have you on board, and we wish you a very happy festive season and a healthy and, of course, prosperous new year. I hope lots of those stock picks do the right thing for you.
Thank you very much, James and Tony. Great to be here, and same to you.
And Tony, that was our last episode of the year, and I've got to say, it's been fantastic fun launching and building the Chanticleer podcast over the past few months with you. So thank you, mate.
Yeah, look, thank you, James. It's been great. And thanks to our thousands of listeners. We've loved your feedback and questions over the last 14 episodes, I think it's been.
Yeah, fantastic. And of course, a podcast like this doesn't happen without some great support behind the scenes. We are very lucky here at the Chanticleer podcast to have 2 brilliant producers, Lap Fan in Sydney and Alex Gow in Melbourne, who make us sound fantastic every week, do lots of great preparatory work, and we really appreciate all the fantastic work that they've done this year. And also Fiona Buffini, who is the executive producer of the Chanticleer podcast and also our new editor. So Fiona, thanks again for your support. We'll be back in early February, and until then we wish you and yours a Merry Christmas and a very Happy New Year. See you in 2023. If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lap Fan and Alex Gow. The executive producer is Fiona Buffini.
Merry Christmas!
The Australian Financial Review.